Right, so we got another question here from Ali. Ali says, I've heard a lot online about manipulation. When trading session breakouts, do you look to identify manipulation before taking any trades? Do you know what, Ali? Okay, right, let's get ready to rock and roll here, guys. Let's go. We got 9 seconds to go. And we're out. A lot of mixed volatility in the bag at the moment. Nice to see the market breathing and flexing without us getting triggered in, though. We did get a 4% rate as expected, so we did get the 25 basis point cut. Markets are in the digestive phase at the moment. Things are just working out. We should see a market rally from this point on. It's quite nice to see that we haven't just had the clean bar in one direction, because it does mean that the spreads are still quite tight. Got a good fill on the US 30 Dow Jones here, guys. Really, really nice fill, but we are at risk because of the fact the market is not rallying just instantaneously like it can do. So we are at risk of this one coming down. We could form a bit of a nasty doji. It's fine. We're well positioned at the moment. We've got a lot of room to breathe this evening. We've got room to play with multiple orders. So we'd definitely be going for a second attempt if this one fails. But so far, so good. Let's check out the NAS 100. NAS isn't really liking it. It's not really doing too much of anything at the moment. The initial reaction from the rate cut itself, very, very minimal. Let's have a look at the DXY quickly. So DXY sentiment shift, not significant. All eyes on Powell, guys. All eyes are on Powell. Don't think the rate decision itself is counting for much at this rate. The DXY is just literally doing nothing. Not much of a bar whatsoever. US stocks are holding their gains at the moment, but it's very, very flaky. We'll have to see what happens. But I am happy for the sake of the fill that we've got, because I've got pretty much bang on. Let's check out the Euro USD. I mean, there's not going to be much to check out at this stage because we're not seeing the volatility come through. So we've got a bit of a hammer candle starting to form in the Euro dollar. We did spike down to 116.35. It's currently trading 116.49. We've got high coming up in the market here. Big liquidity top. That's at around 116.65. So we're not far away from that. Only about 15 pips away before it's going to hit a brick wall. Really not seeing anything going on though from this event so far, team. Not seeing anything at all. Stocks are sliding as well. Dow Jones now trading 89.2. A lot of indecision here. A lot of buyers and sellers coming in. The tape's going crazy. Right, just took a 0.2% hit on the Dow Jones long. Like I say though, that's absolutely fine. I'm happy to take a second attempt on this one and load that up ready to go. Going to wait for a little bit more consistency here in the markets though at the moment. Not seeing too much of anything. So far, it's been a real non-impact event. I've still got the short in the NAS 100 loaded up. The spreads are tightening again as well, which is good news. Yeah, not too much going on. Not too much going on. Right, let's get to some messages. Hey Jack, Jack Buckle says only for a little while. I see that oil hit the trigger. The oil market did hit the trigger, yes indeed, and no problem with you only being here for a while. Anything is great. Good evening to you, Michael. You're driving. Okay, that's fine, so long as you're only listening, mate. Only listening and not watching whilst you're on the road. But wishing you a lovely evening wherever you are in the world, buddy. Glad to have you here. Hey, Cora Tim as well. Good to see you, mate. Oh, guys, this is painful, isn't it? Painful FOMC at the moment. Like I said, all eyes are going to be on Powell tonight, so that's where the real show is going to be. The problem is, we got 25 minutes to go before Powell comes online, so we're going to be doing a bit of sitting and chilling, I think, until that time. Gold's not moved a muscle, trading directly where it was pre-Fed so far. None of these markets have moved anywhere. What's Platinum doing? Nothing at all. No. What's our USD yen doing? How did it go at all? No. No. That's all good. Let's have a quick look at the heat map, see what equities are doing as a result. I'm going to check out the Russell, get a broad market scope on what's going on the equity side. Yeah, pretty mixed bag. I'd say a lot of trading down, more than up though at the moment. I wonder where this pressure's coming from then. Let's have a look at the... Okay, well, so far we're not seeing anything. So far we're not seeing anything at all, team. I don't really know what to say other than that. There's nothing to comment on. So, now's the time to down your drinks and get ready for round 2, I suppose. I'm going to get ready with the Fed press conference as well. Fed press conference. I think I'm going to watch this on YouTube this time around. I remember the last time the Federal Reserve site was actually really slow and it lagged a lot. So yeah, watch it on there next. That's fine. Is that coming through? Let's have a quick look. Just make sure. Yeah, that's looking good. Yeah, that's looking good. Awesome. Okay, cool. All right. So yeah, I mean, we're just gonna be sitting tight here now, guys. Asif, good evening to you, sir. Good to see you. Hey, Ali. Ali says, "What's your drink of choice for the evening?" I've got myself actually. Well, as it happens, I was talking about choice of poisons and so on and so forth earlier. I've decided to go for not just a gin, but I've got a Fanta Zero with it. And the reason being is because we ran out of tonic, and so I stole one of the kids' Fantas. So, yes, top tier drink for me. It's actually really bloody nice. It's lovely. I'm down with the kids, man. Alright, what are these stocks doing? God, let's have a go down. Let's go down on the... Oh, look at that. What a murder scene. Boy, oh boy. That's what we get for a 25 basis point cut in the US. There's some gnarly looking price action right there. Wounded. Well, that's that. We've got 20 minutes to kill. What are we going to do? Tell you what, let's turn this in. Let's turn this show around. Is there anything that anybody wants a miniature workshop on? Let's dig in. Let's dig into something. Let's get our brains thinking. Anybody want to know something relatively specific whilst we've got 20 minutes to kill? I don't mind what it is, so long as it's market related. And gives you guys an opportunity to ask questions that aren't in the sessions every day as well. Or do you know everything already? Is that where the silence comes from? You can see we got a typer. Coratim's coming in, so we'll wait for his response. Let's have a look at European stocks. We got a relatively decent long on the UK FTSE this morning. That wasn't bad. This was our UK FTSE from the European breakout session this morning, which is quite nice. Played out really decently on that one as well. So yeah, that was good to see. There was the short availability here as well. We got the breaker structure below this point for the move back down into 96.89, but yeah, we had positions both sides of the market. No man's land structure in the middle was really great, and then we got the breaker structure above. So that was pretty decent, 1 to 2.33. That covered the losses from the Fed event so far. We did get a decent short in the NAS earlier as well. That was from the US Open. That was from the session that all of you guys were at earlier on. And that was from the public event earlier on today, so that was quite a decent one. Got a secondary late opportunity as well for those of you who might have not seen it in time. So that was the original entry, and this was the second one right here where the red circle is. So that was decent as well, another 1 to 2.6. These were both at 0.25% risk, that UK FTSE and NAS trade as well. So yeah, we were certainly up over 1% for the day. Currently trading, well, currently net profit of around 0.8%, I would say so far now. US stocks still not reacting, still not doing anything. That's fine. Waiting for the power. Right, let's go back. Coratim asks how to recognize times when not to trade in general. Okay, so yeah, that's a really good question. So usually what I do is I try to break down the day, okay, into different cyclical times. So you think of the term cyclical, and you think over the course of a year. So of course you think Christmas time, the period between, let's say, December 10th and January 14th is dead zone. It's incredibly high risk, increased levels of risk, therefore flash crashes and black swan events in the market. So I try to keep the portfolio at a minimal operational level as possible. In and out trades in the US indices only for that period of time. You won't see much in terms of FX, alt metals, fixed income, anything like that will be completely put to bed until we resume full trading capacity and operations. That happens mid-January. But day to day, you can actually break down let's say a 10-hour trading window in just the same format. So, for example, I wake up in the morning, usually it's about 6 a.m, 6:30, get to my screens. I say get to my screens, usually I dawdle around for a little while, I grab coffee and, do the whole thing with the kids, school runs and so on and so forth. But yeah, so I get to my screens, I usually get the trading room open, I send out the portfolio opportunity European indices in the morning. That's at around 7:30 to 7:45, ready for the 8 a.m. open. Now I do that every day, specifically before 8 a.m, because from 8 a.m. after the European bell rings until 10 a.m. is when the most prevalent trading opportunities are opening. You have the European indices markets which open. You have the European FX space that opens and commodity space as well. And this is where the prime time volatility and the structure takes place. But then what happens is you get to 11 o'clock in the morning. 11 o'clock in the morning, all of the desk traders, which is exactly what I used to be, all of those desk traders, we all go out. We all take a break. You either go downstairs, you get out of the office, go for your smokes, you go and grab, your food off the stalls or whatever. You do whatever. That is your time where you go for a break. And that's it around that time. And you can perfectly match the price action. Sorry guys, just bear with me. See a little bit of a... No. Yeah, no, that's fine. So, and you can perfectly match the price action to the psychology of people, because at the end of the day, what you're looking at, what you're witnessing every day that you're here is just people, right? So when you are thinking about how people move, how people work on a day-to-day schedule, 11 to 1 are blackout spots where the markets usually completely die down and trading volume diminishes. So then this is where you want to remove your money from the market. You ideally would have hit your target profit before then, and you're out with your money ready to then prepare yourself for either the 1:30 time, which is where the FX space and the commodities markets open for the US, or the 2:30 time where the US opens up for US equities and indices trading, which is where you have that window, that magic window of opportunity yet again taking place in the afternoon. So you have two major opportunities every single day. Now I feel particularly bad for the Asia traders. Now we've got a couple of those guys. I don't know if anyone here is an Asia session trader, but we've got a couple of them in the trading community. And what they do is they have to sort of work their time schedules out and to be able to trade those events when they're, when that may be at 10 at night or 1 o'clock in the morning, if it's a really sort of significant period of time they know they're going to make some money. And that's the kind of dedication they bring to the table. It's easy for us in GMT time zones or in Europe and so on and so forth, because we're pretty much made, right? We've got the two best trading sessions of the markets available at our fingertips. So what I do then is I compartmentalize my day between the European Open for 3 asset classes and the US Open for those 3 asset classes. Now, what you can do is plan your day around those 2 events and spend the rest of your time in personal development or lifestyle development, whether that be gym, getting out, being outdoors, or getting caught up on stuff that you need to do, additional study. You only really need to be prevalent in the markets between 8 a.m. and 10 a.m. And I would say 1:30 p.m. and 3:30 p.m. GMT every day. You do not need to be in the markets from 8 until 10 at night every day, like a lot of people do, especially in the early years. All you want to do is just be glued to the screens, but actually it's one of those things. It's almost like counterintuitive, right? You think the more time you're at the screens, the better you will become and the better you'll be, but honestly, it's not. It's what's the famous saying? Everything. I've got a complete mind block now. It's probably the gin kicking in. What's the saying? Anybody in the room, give me a hand here. You have to take everything with a, reasonable amount. It has to be a reasonable amount of everything. You can't go too much, too full on into any one thing. So that's how I do that, and that's how I break my day up. So I hope that helps. Does that answer the question, Coraton? Was that satisfactory? I suppose. Yeah, no worries, no problem at all. Right, so we got another question here from Ali. Ali says, I've heard a lot online about manipulation. When trading session breakouts, do you look to identify manipulation before taking any trades? Do you know what, Ali? I even myself have succumbed to using the term manipulation. Okay? Now, what we've actually witnessed right here is classified by many to be manipulation. We have manipulation in the market going on right now, right? And this then also comes into play with fake out methodology as well. And look, I am all about the fake outs. I believe in them. I believe what's going on behind that. I have a deeper understanding of what's going on behind the scenes. So if you look at this area in here, for example, this is a fake out. The market's come up, we've broken structure. This is the original structural point. We've broken down, we come back up, nice big breakout. Lots of retail traders then immediately surge orders into the market, all jumping into the market, bang, stop out. And then what happens is the retail traders break the next point of structure, which is this area. Okay, so you have this area in here as the structural breakout point. And then all the retail traders, all of a sudden, they start going short, entering shorts into the market like crazy frenzied feasts here. But the problem is the market then comes back up and they get stopped out again. So it's an ongoing process. But when you have a significantly deep understanding of commercial trading practices, you then understand that things like market manipulation, not necessarily the right term, not necessarily the right wording there to use for what's really going on and what's really at play, because everything that happens in the markets can be fully explained just via commercial trading practices and how they move incredible sums of money, eye-watering sums of money around the markets. Doesn't really come too much down to manipulation, comes more down to the fact that these guys are executing orders worth $10 million a piece, and that's going to shift the markets. And it's how they do that. It's how they unload funds into the markets of in those particular kinds of sums, because they have to do it in a way that's going to be cost effective. You think when I trade at the moment with my account size, I'm probably being charged a fair bit. I don't know offhand what it is in completely, but at times it could be maybe 80 to 120 quid a trade. So if you think about that, but then you think about the guys that are trading accounts that are $500 million or maybe $250 million, they're going to be charged thousands per trade, and it's going to cost them tens of thousands if they don't execute their trades right. But what happens is when they're unloading their funds or removing initial positions due to economic biases, it's going to make the market volatile. So what's happening right now is a bunch of commercial guys are sat at desks monitoring the news, and they're unloading and reloading a ton of orders into the market, getting ready for the next leg, which is then what causes the market shake-up, which is also what people who are slightly, and there's no shame in it, but maybe slightly a little bit less experienced or haven't maybe worked on the commercial side of the markets, don't have an understanding of. And so then they come out with various terms like that. So look, this is not a shame game or anything like that. We've all used the terms and stuff before, but that's really what it comes down to at the end of the day. So yeah, I mean, back to look, the main question I suppose is, do I look to identify manipulation before any trades? No, not really. I mean, the manipulation I suppose would be identified automatically in the risk profiling process that we undertake with every single position that we take. There is a very stringent risk profiling that happens before we take every single trade that we do. If you are an avid follower, if you really dig into the system and understand obviously the way I look at the markets and are an avid follower, I suppose, at the end of the day of the way that I trade, then the risk profiling process you'll have a really good understanding of. That's a long one to dig into now. Won't be able to dig into that one this evening. But yeah, it's an interesting topic. I tell you what though, man, if and this goes out to anyone at all, even to those of you out there on YouTube watching this on the other side of the trading community right now, you can gain access to the IO trading course. All you need to do is join into the community on a UTC basic tier, and you will gain access to the IO trading course. It's open. It's open to everyone. So I don't want to, I never, ever, ever want to hide education behind a paywall. Bottom line, I want that to be out there. The markets are a vast being, and anyone who thinks they have a system that, if it's going to be found out by too many people, it's going to lose its edge. I mean, you got your head in the clouds. You really do. You have no idea. So yeah, the system is out there for you guys, but you have to join as a UTC Basic member to do that. And Ali, if you want it, just request it from me. Hit me up, send me a DM, and I'll send you the access pass. You get stuck in. Yeah, no problem. Yeah, no worries. Right, how are we doing on time? Let's have a look at what are we doing on time. 5 minutes to go. That's not bad, is it? That's not bad. We've actually delved into a couple of really decent talking points. We've still not seen the markets do anything at all, but that's okay. We'll get ready for Fed Chair Powell's press conference. I will, as I usually do, be dissecting the information in real time, so we'll see what he's got to say, and I'll be adding any necessary commentary to break it down into bite-sized chunks, if necessary. But ultimately, let's just see where it goes. Sometimes, these Fed events can be a little bit dry. Just a word of warning. I'm a nerd, and I did study economics. I'm a student of economics, and I do find it interesting. But it can be a little bit of a dry subject for some people. That's absolutely fine. If trading opportunities are arising, then I will be hit firing them out as and when as well. So please do stay tuned on that front. But we'll see what the Fed's got to say, and we'll go from there. So let's get ready for it. So what I'm going to do, am I going to full screen that? I wonder if you guys are going to be able to get a good enough view. If I don't, I'm going to share the session. If there's any viewing issues, please do let me know and I will full screen it. So let's go down here, change the stream over and share. I don't know if this stream's going to be a little bit small for you guys to see clearly enough. It's no problem at all. It's no problem at all if you let me just full screen the damn thing. It makes a hell of a lot more sense. So that's fine. We'll full screen it. There we go. Now, some people have historically said that the volume on it can be a little bit low, or not distorted, but a little bit quiet on the Discord side of things. So there's nothing, unfortunately, that I can do about that. So just be aware that the volume might be low. You might have to whack your speakers up in order to get a decent read on what's going on. Alright, we've got a couple of minutes to go. It'll probably be a minute before it all kicks off as well. I usually do a bit of chin wagging, a bit of political stuff beforehand. Still getting absolutely nothing out of these markets this evening. Complete non-impacted rent from the initial release. I am a little bit surprised. Yeah, I am a little bit surprised. I mean, 25% of the market's priced against a rate cut, and this is all we saw as a result. Yeah, definitely a bit surprised. I think a lot of money's probably still in the market waiting for Powell though. We've had a little bit of exchange here, haven't we? A few orders being removed and taken away and added again by the commercials. But it's not caused much market volatility at all. What's gold over here doing at the moment? 0.73% up today. It is slipping though, isn't it? We had the initial knee-jerk reaction, very stereotypical. Has slid a little bit since then, but honestly not that much, not a great deal. We look at this on a 15-minute candlestick to consolidate things. nothing. Yeah, it's all right. I think we'll see some more out of Powell. DXY's not moved a muscle. Maybe they're all just having a gin and Fanta behind the scenes. Okay. Here we go. Kick back, enjoy a drink, and let's see what Fed Chair Powell's got to say about things. Oh, here's the man himself. Looking absolutely shattered.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy.
Short in the
based on
Dow Jones is now
economic
triggered,
data, the
guys.
evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting,
Some pretty dovish
there were
statements here, guys,
strongly
from the
differing
Fed.
views about how to proceed in
A lot of
December.
downside risk in the
A
forecast.
further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing
Come on,
repo
just a couple
facility.
ticks more. Going to land a real nice
In addition,
opportunity
the
here in the
effective
Dow.
federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen
Boom,
from
just landed a 1 to
35% about
3.14 on the Dow
21%.
short.
In December, we'll enter
Beautiful.
the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick Timmeros of the Wall Street Journal. Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion? at your
Looking
next
for a
meeting?
potential retest of this
Well, as
zone
I
above
just
price on the NAS
mentioned,
100, followed by a
A further reduction
continuation.
in the policy rate at the December meeting is not a foregone conclusion, as I've just said.
I'll give you a call
So,
out when the trade gets taken if
I
it
would
does.
say that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have how that affects the outlook and the balance of risks, and I'll just say that.
You and some of your colleagues have framed last month and maybe today.
Okay, I'm short the NAS.
As a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement
Had the
in the
retest
outlook?
in the second leg of the run
Or
ongoing.
could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the
very confident response.
The fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, you know, again, the balance sheet, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be
Slightly more
freezing the
hawkish,
size of the
you'd be in
balance sheet.
trouble.
And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual.
And Nas
growing,
trade is
nothing more
hanging
than
on
that.
by the
So
skin
that
of his
does give you
teeth at the
some
moment.
comfort.
It's fighting it out.
But if this
that's for
shutdown
sure.
lasts a while longer and you don't have that data
doesn't
in
look good, though.
hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, we get, like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Possible long option in the S&P 500.
Lisbon,
Posting that out
CNBC.
now, but don't press any
Mr. Chairman,
buttons
can
until
you
I call it out.
characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw
My
we
NAS
had
100's
two
gone in the bin.
dissents,
The
one
spread,
for 50
spread
and
got,
one for no cut.
yeah,
So,
spread's taken me out. TradingView
that
hasn't
was a
registered
strong,
it as a
solid
loss
vote in
yet,
favor
but
of this
the
cut.
spread has taken me out.
The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
If he says yes to
So
this
the
question, the stocks
place
won't
we'll be
like
on
it.
December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point.
Master politician
And
team.
that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet. And there's a desire that the balance sheet be, right now, it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment,
I'm going to push in for an S&P 500 long here, guys. This will be probably my last trade of the evening.
Makes a mistake on employment.
I'm going to have a go.
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Good signs there from
Great,
the,
thank you.
from the
Chris
Fed.
Rugaber, Associated Press.
Pretty
there's a
confident
big
stuff.
investment boom
2%
in AI
inflationary target
infrastructure
for our
right now,
US
as you
markets
know,
is
and
very, very
wondering
bullish
if the
news.
existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
All right, ladies and gents, if you can
Just a
bring
quick
your
follow-up.
stop
You
losses up to
mentioned that you do
break
have data that
even.
you're looking
Actually,
at
no,
for
sorry, bring
inflation
your
and
stop
growth
losses
in
up
the
to around
absence of government data.
68.83,
Could you
I would.
give us a sense? I think we know a lot about the
That's
jobs
going to
data
pay the
that's
cost
out
of the
there. Can you
spread,
give us a sense of
remove
what
the
you're
risk from the
looking at to
market,
track
and we'll
inflation
just
in
see
the
where we
absence
go
of
from
government
there.
data?
Worst
Thank you.
case scenario,
So it's a
you've
lot
made a
of things,
few
and
pennies.
it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down.
Hey, ladies and gents,
that could or could
realised I
not.
had myself
I don't
on
know
mute.
how that's
Sorry
gonna
about
play
that a
into
moment
things.
ago. If
We
you could
may
just
get
bring your stop losses
data
up to the
may
red
come
line,
back, but there's a
indicated on the
possibility
chart.
that it would make sense to be more
It's
cautious.
going to
about
remove the
moving.
risk from the
I'm not-
market.
Yeah, I'm not
If the market
committing to
comes
that. I'm
back
just saying
down,
it's certainly
worst
a
case
possibility
scenario,
that you
we've
would say,
paid the cost of trading the
we
S&P.
really can't see, so let's slow down.
As a follow-up, in the debate in this meeting, we saw recently some pretty big layoff announcements.
Probably
coming
be
from
looking at end
Amazon
of
and
the
others.
session soon.
Wondering if that figured
Regardless of
into
this
discussion at all,
S&P
that you're
500.
starting
If
to
it
see the
end- if
turn,
the
this
S&P
tension
gets
between
knocked out in a
growth and
moment, then,
employment starting to be resolved, to the
then we'll
detriment
bring
of
it to a wrap up
employment.
there.
And secondly,
The questions are becoming
some of the
a
stress is
little
starting
bit
to appear in
unimportant
the bottom
for the
spur
market
of the
context
K,
for
as they
me
call it,
now,
household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs. And much of the time they're talking about AI and what it can do. So we're watching that very carefully. And, you know, yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, you know, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, you said far from it. So if a cut might
tune into this question, guys, important one.
For December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, you know, we've now moved 150 basis points, and that we're down into you know, you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you know, you can argue these positions since it can't be directly observed, the neutral rate. So, you know, I think for some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, you know, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
I just got knocked out of the S&P trade for a very small profit, probably the smallest profit this year, in fact.
Risk, or is there a deeper philosophy?
I am going to
look. Everybody on the committee
slow down
is
the session
deeply
now, so
committed
let's just
to
get back
doing
to
the
the
right
chart here
thing
for a moment.
to achieve our goals, maximum employment and stable prices. You have differences on how to do that, and as I mentioned, some of that is different forecasts, but a lot of it is also.
All right, guys. So it's been, in general, it's been a pretty mixed bag this evening of price action, I would say, versus volatility versus what we've now found out. I don't think we're probably any smarter, really, on the context of the US economical situation than we were before the press conference, apart from one thing, and that is about the December rate cut. Now, the original dot plot revision had a rate cut of 25 basis points in the market for the December meet, whereas now we don't know. So there is a little bit more, I would say, shade thrown around that December event. That's the only thing that we've been given a heads up on, really, over and above the previous Fed meeting, the previous Fed press conference. So that's quite interesting. So maybe the December one is really where the action's going to happen, and possibly not, and possibly, you know, where it didn't happen today. It's a little bit unfortunate, I suppose. I was expecting a lot more than we were given. We, at the end of the day, we've taken 2 losses that were in the Dow Jones and the NAS 100. We took a loss in the Dow long. We took a loss in the NAS 100 short. Both of these, because of the nature of the event and the lack of volatility, were actually on point at minus 0.2% trade. So that's really good, because usually we bring down the 0.05 to account for the potential of slippage and so on and so forth. But actually both of those were on point. They were minus 0.2 positions. We took a lovely win in the Dow Jones short at a 1 to 3.14, which yielded 0.628% return, and then we minus the 0.4% from the other 2 losers, and that leaves us with a net return of 0.228%. We also took an incredibly tiny win. I don't even want to call it a win, in the S&P 500, which essentially just paid the cost of the spread, but that brings our net return up to over 0.3128% is our net return for this evening's Fed event. So it's not great. It's a very, very slow market at the moment, very slow return this evening, which really quite accurately represents where we are in the markets at the moment. I am a little bit surprised. I mean, given the price action, given everything that's been going on over the course of the last few weeks, and especially the trading day that we had today, I really was anticipating a mega event this evening, just kind of tying in everything leading up to this event. It's been slow, it's been sluggish, there's been a lot of stagnation in the markets. I was thinking we were going to see that kind of really ramp up this evening as we hit the Fed event, but actually the markets just continue to be at a relatively slow pace. But look, guys, I am going to bring things to an end there. You can't foretell if there's going to be, the incredible amount of market volatility that you want, or if it's going to be as action-packed as you hope it's going to be. But nevertheless, I hope you guys enjoyed the session. I know it's a bit of a dry subject, the old press conferences, but they are important to see now and again, I would say, especially the US ones. And, there were a couple of things in there, bits and pieces that you guys hopefully can benefit from going away from tonight as well. So if there's no further questions or anything, I will indeed bring it to an end. For those of you out there on YouTube, please feel free to join into the community at any point in time. Sign yourselves up on UTC Basic, and you will get access to the mega economic events like this, the UTC market report, and so on and so forth. And for those of you inside the community, I hope you have a fantastic evening. Good luck to you out there. Look forward to catching up with you tomorrow as well. For those of you who are the UTC traders, looking forward to catching you in tomorrow's session, where we can build out our books and look to see if we can get any last minute weekly trading opportunities before the weekend. So take care of yourselves, and I look forward to catching you then. See you later on. Bye bye.